Well, good evening, guys. I wanted to take a couple of minutes and walk you through the loan amortization schedule that we're discussing in Finance 309. This might be applicable for other courses under other course numbers, but for today, we're talking about a class we had in Finance 309 where we dealt with the construction of a loan amortization schedule. I first want to make you understand why we would use this in Finance 309 as we're talking about real estate valuation modeling. This may be different for other classes and for other utilities of the loan amortization schedule, but it's what we dealt with today, and I want you to understand it because you're going to be required to create an Excel spreadsheet that includes the utility of a loan amortization schedule as we then go ahead and work on problem sets and Excel assignments through the real estate modules in Finance 309 this year. We need to determine the amortization schedule because that's where we identify what part of each payment that is made on a loan, in this case, a mortgage against real estate, is principal repayment versus what part is interest repayment. We need to do this because the cash flow variables that are used in real estate valuation modeling are very different than the cash flow variables that we would use in other forms of asset valuation modeling. In most forms of asset valuation modeling, we're going to come up with a free cash flow. And effectively, we're doing the same thing in real estate modeling, but in other asset valuation modeling, we try to make that free cash flow agnostic of the decisions made by the management or stakeholders of the company as to how to capitalize the asset. In real estate modeling, we recognize how it is being capitalized and then utilize anything resulting from that decision. So those are two very different variables and two very different ways of looking at this. Further, we need to not only understand principal and interest, which equals the payment, of course, but we need to understand what part is interest, what part is principal, because when we're thinking about the tax liabilities that are going to result from the cash flow, we need to remember that interest expense is tax deductible, whereas principal repayment is not. So we need to have those as separated values. So with that, I'm going to go ahead and move to the Excel spreadsheet and take a look at what we've got going on here. So let me share the screen. What you're looking at now is a 30-year loan amortization schedule. I've given you some data here that is given, leading to a calculated piece of data. I've given you some syntax and function label and description and link to some of the different kinds of functions we're going to be using. And I'll go ahead and post these links along with this video at the end of the video, since I know you can't see the links completely here in the video as I'm doing it for you right now. But let's look at what we've got going on here. First, we have some variables that were given. In this case, I've got what I'm calling a loan origination date, and that's the date the loan goes into service. And it is, in this case, the last day of a month. And we're going to use that convention throughout this. That may not always be accurate. And in all candor, I've set up this model for the last day of the month. It can be set up for any day of the month, but there is a different set of date functions in Excel to do that. And I didn't want to get too deep into those particular weeds. So for this case, I'm making my assumption that this is always as of the end of the month. I'm giving us the loan amount, of course, the number of years for which the loan is being repaid, the periods per year, monthly, which is the case in many loans, certainly many that are collateralized against real estate, and then the interest rate of the loan. And then I go ahead and use the first function in Excel and ask to find the payment. Well, you probably are already familiar with the payment. I've given you the syntax right here. But the payment on the loan is going to be a function of the rate, which is a periodically specified rate using the decimal equivalent, not a percentage. And then it's the number of periods, not the number of years, but the number of periods. It's the present value, which is the loan amount, and then a future value option, which you don't need to put in. I typically do, and that is 0. When a loan is paid off, we expect the value of the loan to be 0. And then there's a type of loan option, and the type would be loans that accrue interest as of the end of a period, which is the default, and for which we need to give no input, or beginning, in which case that's called a discount loan. They're rarely used, and we would need to note that. But for the work we're doing here, we're supposing that all mortgage loans are going to accrue interest to the end of a period. And that's the standard of the default, not simply for Excel, but for business done in the mortgage industry in this country. So as you look at this, my rate is C8, or the actual percentage rate, divided by 12 periods per year, so months. I'm then going to go ahead and use for the periods, the number of years times the periods per year, or months. And then for the loan amount or present value, I'm using the loan amount in C5. And then I used 0 for the future value rather than just taking the default. So this is in black, not blue, because I've calculated it using some of my blue inputs. So now what do I have is I have to go through the columns and rows here. Well, I have a column for the payment month and year. It's actually a column payment date, month and year. I've got a column for the payment itself, a column for the principal amount of that payment, a column for the interest amount of the payment, a column for the total interest, so this is just a running total, and then a column for the remaining balance. And let's see where those come into play. Well, in this case, to find the end of the next month after the loan origination period, I'm utilizing the EO month function. So that's the end of month function. And the end of month function is equal EO month. And then in parentheses, we put the start date, which is 12/31 of 2021 in this case. And then the number of months from that, which is 1, and it gives me then the end of the next month. You'll see I do this in each one of the rows here. So for month 2, I take end of the month from the prior period, advance it 1 month. I do the same thing for month 3, and so on and so on. Okay, so for the payment, I'm simply referencing this payment amount that I've calculated over here in C9, and I reference it for each and every month of this loan. So I've got C9, and you can see I've used the absolute reference dollar signs here. And I do the same thing for every month. For the principal amount, I want to take the interest, or I want to take the payment amount minus any interest expense. So I kind of put these columns a little bit backwards. I've got principal and then interest. You might have thought it might make a little bit better sense to have interest and then principal, but you'll see in just a second why I've done that. So I've got the principal amount being the payment amount minus any interest expense. For the interest amount, I use a somewhat more complicated structure here. So kind of think through this and follow me. Since any given month isn't just a month, it's a number of days, and in any given month, it might be a different number of days than the month after or the month before. And in loan calculations, we're very specific. So we need to know the number of days that I am paying interest against what principal balance for that particular calendar month. So what I have is I have C5, which is the outstanding loan amount for this first month. And I'm multiplying it by C8, which is the rate, divided by 365. So C8, or the rate divided by 365, gives me the daily interest rate. Now I multiply this by the dated if command, which is going to tell me the number of days in that period. Okay, so let's examine that for a moment. I say dated if, and I have C4, that's the beginning of the period. F5 is the end of the period. And then in parentheses, no, excuse me, in quote marks, I have D. Now this can be a capital D or it can be a lowercase d, I believe. I don't think it makes a difference, but you may need to check me on that. And when we use D, it tells us the number of days in this difference between the beginning and ending periods. Well, that's interesting for us because what we know then is we've got the actual number of days times the daily interest amount times the outstanding loan amount. And that then will result in the interest expense that we've got. So when I've calculated the interest expense, now I can calculate the principal amount using the payment amount. I have here then also a total interest column, and this is just a running total. So you see I've just used the first period's interest expense, and then I have a remaining balance. And the remaining balance is going to be whatever the principal amount was at the beginning of the period, which in this case, the period began in December 31st of 2021. And so whatever that principal was, or that principal was on that date, minus the principal repayment, and that then results in the principal left at the end of the month. Well, let's look at the next month and see how we've done this as well. So I just have calculated another month. That's just a simple notation for me. I don't use this number anywhere. It just helps me keep track. Here I've used that end of month command again, in which I take the end of month is a function of the prior month plus one more month. I have my payment amount once again. I have the principal payment, which is going to be the payment amount minus interest expense. My interest expense is now going to once again be any outstanding principal, which in this case is the outstanding principal as of the prior period, times my daily interest amount, which is C8, or the monthly rate, divided by 365, now times the number of days in between January 31st of a year and the end of February. And sometimes the end of February is on the 28th and sometimes on the 29th, of course, and Excel knows which is which. It's got a table built in there somewhere, I'm sure. And I've used the dated if command to do that. It tells me my interest amount. I now have my running total for interest. And I only have this running total for the sake of curiosity, by the way. And then I have the remaining balance. And the remaining balance is going to be, again, the prior period's balance minus any additional principal paid is equal to the remaining balance. And in the next period, I go ahead and start that over again. Well, in this case, I've gone ahead and done this for a full 360 months. And so you can run all the way down this. And in this particular case, there was a little bit of remainder in the 361st month that I had to account for. Not a tremendous amount, but there was $11 of interest expense, and that's not altogether uncommon. So as I look at this, what I've given myself is a schedule, a table that shows me month by month of the entire 30 years of the mortgage, what the payment is, and of that payment, how much is principal and how much is interest. I've used the dated if command to find my interest expense. I've used the payment command to find my payment amount. And when I say command, I mean function. And I've used the end of month function to find the date that the payment is going to fall on any given month. Because in this particular schedule, I'm making a general assumption that my payment is always going to be at the end of the month. So let's look at a couple of things very quickly here that might cause you a little bit of heartburn if you use different periods. So let's assume that in this case, we actually negotiated this loan instead of on December 31st, we negotiated it on December 15th, so 12/15/2021. Whoops, got to spell that. I got to do that correctly. Notice then that when I've done that, I have an interest expense that is greater than the monthly payment. Well, in this case, when we closed that loan, there would have had to have been some payment of any interest between the closing date of the loan and the day of the month the loan would be due. That's very common within residential real estate. I've not made this table to be so sophisticated as to account for all variations here. And so as you're using it, I would expect you to go ahead and either always have your loan origination date be the last day of the month, or in this case, go ahead and make some adjustments in here to accommodate whatever that date might happen to be. So I'm going to put this back to 12/31/2021. Again, the reason that we're doing this is exclusively so that we can identify what part of the payment is interest, which is tax deductible, and is going to affect the tax required off of that cash flow in any given period, and what part of the payment is principal, which is not tax deductible. Both of which will end up being deductions as we think about cash flow coming from a real estate project that has a loan against it. So it's got a mortgage of some kind, because it's a different kind of cash flow construction than we use in other types of valuation modeling. Well, I hope this helps. I don't expect you to necessarily in your assignment include these tables. And I don't necessarily expect you to always have the functions listed here. You'll notice I used a function, or I gave you information about a function here called eDate. And depending upon how you structured your date functions, you might choose to use eDate. Because I've structured everything end of month, I'm using the EO month, I'm using dated if, and then I'm using payment. I hope this helps.